Welcome to the Red State Finance Podcast, the show where we break down the markets, the policy, and your money through a clear, common sense lens. I'm your host, Dana.
And I'm Anthony. Thanks for tuning in, everyone. Today, we are following up on something we literally just talked about. In our last episode, we asked what would happen if the AI bubble popped and private debt and leverage blew up in Wall Street's face. And right on cue, the market gave us a real-time masterclass example of what happens when high-tech hype meets the harsh reality of margin calls.
Oh man, Anthony, you couldn't write a better script if you tried. We are diving into the wild story of Leopold Aschenbrenner, the 24-year-old former OpenAI researcher turned mega hedge fund manager who managed to turn a 165-page AI essay into a $20 billion-plus investment empire, only to watch it collapse by 67% in a single month during the July 2026 tech rout.
A $16 billion emergency fire sale to Citadel, prime brokers breathing down his neck, and a letter to investors admitting, and I quote, "We let you down this month."
But this isn't just about one guy losing a mountain of paper wealth. It raises a massive, fundamental question for the entire financial system. Why on earth are tech billionaires and institutional investors handing total, unchecked control of tens of billions of dollars to 24-year-olds with zero trading experience?
And more importantly, what can everyday folks sitting at home with their 401ks learn from this insane spectacle? Grab your coffee, hold on to your risk limits, and let's get into the numbers. Dana, before we talk about the blow-up, we have to talk about how a kid who wasn't old enough to rent a car without an underage surcharge ended up controlling more money than the annual GDP of small countries. Who is Leopold Aschenbrenner?
On paper, the kid is an undeniable academic prodigy. Born in Germany, he graduated valedictorian from Columbia University in 2021 at just 19 years old, with a degree in economics, math, and statistics. He spent time doing research at Oxford's Global Priorities Institute, and he was even a member of the FTX Future Fund team back in 2022, which, as our listeners know, was the philanthropic arm of Sam Bankman-Fried's crypto empire before that whole circus crashed into federal court.
Yes, starting your career on the FTX team. Truly the gold standard of conservative financial management and risk controls.
Right, but after FTX collapsed, Leopold landed at OpenAI in 2023 on their high-profile super alignment team, working under AI legends like Jan Leik and Ilya Sutskever. His job was to help figure out how to control super intelligent AI. But in April 2024, OpenAI fired him. OpenAI claimed it was over an information leak. Leopold claimed he was actually fired for writing an internal memo to the board warning that OpenAI's security was so weak that foreign spies from China could steal their secret algorithms.
So he gets fired from OpenAI, and what does he do? Does he take a vacation? No. In May 2024, he publishes a massive 165-page online manifesto called Situational Awareness.
And that essay took Silicon Valley by storm. In it, Leopold basically predicted that artificial general intelligence, AGI, would arrive by 2027, followed quickly by superintelligence. He argued that to make this happen, the world would need an unfathomable explosion of physical infrastructure, trillions of dollars in microchips, custom memory chips, massive data centers, and specialized power grids.
It was the ultimate bull case thesis for the AI supply chain, and the tech elite in Silicon Valley didn't just read it, they drank the Kool-Aid. High-profile billionaires like Patrick and John Collison, the founders of Stripe, along with major venture capitalists like Nat Friedman and Daniel Gross, stepped up and said, "Here's a blank check. Go build a hedge fund around this idea."
And so, Situational Awareness LP was born in 2024, named directly after his essay. And for the first year and a half, Anthony Leopold looked like an absolute genius.
Oh, he was flying high. He took that money and concentrated his bets heavily on the AI supply chain, companies making high-bandwidth memory chips like SK Hynix and Micron, specialized cloud and server hosting firms like CoreWeave and Nebius Group, power providers like Bloom Energy, and data center suppliers.
And he didn't just buy the stocks with cash. He took prime broker loans from major Wall Street banks, Goldman Sachs, JP Morgan Chase, Bank of America, to heavily leverage his positions. When the AI frenzy was at its peak in late 2025 and early 2026, that leverage acted like rocket fuel.
By the end of June 2026, his fund's net return was up an astronomical 439%. The assets under management ballooned to over $20 billion, with some reports putting the total leveraged exposure near $45 billion at its peak.
Imagine being 24 years old, sitting in San Francisco, looking at a balance sheet where you've turned an essay into a $20 billion empire, generating 400% plus returns, and being hailed as the visionary prophet of the new technological era.
You'd think you were completely invincible, Dana. You'd think the normal laws of finance didn't apply to you. But as we always say on this show, leverage is a wonderful elevator on the way up, but it's a trap door on the way down.
And in July 2026, that trapdoor swung wide open.
The catalyst was the exact macro-level AI stock correction we've been warning our listeners about. Investors started questioning whether all these mega tech companies were actually getting a return on their trillions in AI infrastructure spending. Semiconductor stocks began to pull back. Memory chip makers like Micron and SanDisk tumbled by 30 to 50%. Nebius Group and CoreWeave took massive hits.
Now, if you are a traditional fund manager running an unleveraged, diversified portfolio, a 30% pullback in a sector hurts, but you survive it. But when you are leveraged to the hilt, a 30% drop in your underlying assets triggers what is known in finance as a margin call.
The prime brokers, Goldman, JP Morgan, B of A, look at the declining collateral and say, "Hey, Leopold, you owe us cash right now." And when market liquidity dried up, Leopold's fund found itself in what he later described as essentially similar to a bank run.
Yeah.
Other hedge funds on Wall Street smelled blood in the water. They knew situational awareness was over-leveraged and held massive positions in specific names like Bloom Energy and SanDisk, so short sellers relentlessly hammered those exact stocks.
It turned into a death spiral. In just a few short weeks in July 2026, situational awareness's portfolio tanked by 67%. Over $10 billion in value vanished into thin air.
To avoid total collapse and stop the prime brokers from seizing his assets, Leopold had to execute an emergency fire sale. Late on a Wednesday night in late July, he negotiated a deal to sell roughly $16 billion of his fund's public equity assets at a steep discount of over 10% to Ken Griffin's Citadel, one of the largest, most ruthless institutional hedge funds on Wall Street.
Think about that dynamic, Anthony. Ken Griffin and Citadel stepped in like classic Wall Street vultures, buying up high-quality tech assets at basement fire sale prices from a 24-year-old who was forced to liquidate to cover his debt.
The next day, Leopold had to send out the dreaded mea culpa letter to his billionaire investors, writing, "We let you down this month. We came closer to permanent capital impairment than is acceptable." He vowed to eliminate all leverage and run his public stock portfolio on cash moving forward, saying these were very expensive scars.
That brings us to the core debate of today's episode, Anthony. How did we get to a point in American finance where a 24-year-old with zero trading experience, zero risk management track record, and a background tied to the FTX collapse is given sole key man control over tens of billions of dollars?
It's a classic symptom of what I call Silicon Valley wunderkind syndrome. There's this toxic belief in tech culture that if someone is brilliant at one specific thing, like writing math proofs, co-authoring AI papers, or writing compelling 160-page essays, that intelligence automatically translates into being a master of complex market mechanics.
It's total hubris. Being a great AI theorist does not make you a risk manager. Predicting that society will need more microchips in 2028 does not teach you how to handle short seller attacks, portfolio concentration risk, liquidity mismatches, or prime broker leverage limits in 2026.
Exactly. Managing a hedge fund isn't just about having a correct long-term thesis. It's about surviving the volatile path to get there. If your fund gets wiped out on the way to 2027, it doesn't matter if your prediction about 2027 was right, you're already broke.
And look at the governance structure. Why did major tech founders like the Collison brothers or Nat Friedman hand him money with apparently zero adult supervision in the room? Because in Silicon Valley, there is a massive echo chamber. Leopold's essay told tech executives exactly what they wanted to hear, that their tech was going to rule the world and generate infinite wealth. They didn't assign a grizzled 50-year-old risk officer who lived through 1998, 2000, and 2008 to sit next to him and say, "Hey kid, don't take 3x leverage on high beta semiconductor stocks."
It's key man risk on steroids. When you give total control of a giant capital pool to a single young founder without rigorous risk governance, you aren't running an investment fund. You're running a giant leveraged casino account fueled by personal ego.
So, Anthony, let's bring this down to earth. Most of our listeners aren't managing $20 billion hedge funds, and they aren't getting margin calls from Goldman Sachs. But there are crucial practical lessons here for everyday people looking at their own retirement accounts, stock portfolios, and financial planning. What's lesson number 1?
Lesson number 1. Smart does not equal safe. Just because someone went to Columbia at 1.9, worked at OpenAI, or writes brilliant articles does not mean they know how to protect money. Wall Street history is littered with the corpses of funds run by Nobel Prize winners. Look at long-term capital management in 1998. Never invest your hard-earned money based purely on a founder's intellectual resume or charismatic hype.
Lesson number 2, respect the danger of leverage. If there is one takeaway from Leopold's $16 billion fire sale, it's that leverage is a double-edged sword that cuts deepest when you least expect it. When everyday retail investors use margin accounts, options, or leveraged ETFs to try to double their returns on tech stocks, they are playing with fire. If a market correction hits, leverage forces you to sell at the absolute worst possible time, at the very bottom, right into the arms of guys like Ken Griffin.
Lesson number 3. Avoid narrative-driven, concentrated bets. Leopold fell in love with a narrative, the AGI by 2027 thesis, and concentrated his entire fund in a narrow group of interconnected AI supply chain stocks. When that single narrative took a temporary hit, his entire portfolio collapsed. For regular investors, diversification isn't boring. It's your insurance policy against being wrong on timing. If your entire portfolio relies on one tech trend coming true on your exact timeline, you aren't investing, you're gambling.
Lesson number 4. Beware of echo chambers and high-yield promises. When Leopold was putting up 439% returns, everyone wanted in. Investors were trying to get capital into his fund right up until the crash. The public needs to remember, whenever an asset or a fund offers eye-popping, unnatural returns in a short period, it is almost always hiding massive underlying risk.
Absolutely. When the tide turns, the market doesn't care about your valedictorian degree or your vision for the future of humanity. It only cares about cash flow, liquidity, and who holds the debt.
Leopold Aschenbrenner says he learned his very expensive scars and plans to fight another day without leverage. And hey, maybe he will. He's only 24. He's got plenty of time to rebuild. But for the rest of Wall Street and the investing public, his story is a stark reminder of what happens when unbridled tech optimism meets the ruthless reality of financial markets.
Well said, Dana. That is all the time we have for today's episode of the Red State Finance Podcast.
Hit that subscribe button, leave us a 5-star review on Apple Podcasts or Spotify, and tell us in the comments, would you ever trust a 24-year-old with your life savings, or do you think Silicon Valley has lost its mind?
Until next time, keep your eyes on the data, your mind on the fundamentals, and your hands on your wallet.